All right, welcome back. You know, in the world of AI, things are moving at a mile a minute. Strategies pop up, they get hyped, and sometimes they fade away. But the real question is, which ones are actually built to last? Today, we're going to dig into the long-term survival of different AI governance models. We'll explore which ones are truly adaptable and which ones, well, might be headed for the history books. Okay, just our standard heads up before we jump in. This is part 14 of our 15-part overview of a big research report from Virtualization Options LLC, all about AI governance. And as always, remember that these explainers are just a snapshot of what's in the full report. This isn't legal advice and it doesn't come with any kind of warranty. So, let's just put it all out there. This is the big question, right? When we look at all the different ways companies are trying to manage AI today, which approaches actually have what it takes, the DNA, if you will, to make it through the next 10 years? Because things are about to get intense. Okay, let's get into it. No company, no organization exists in a bubble. And that's especially true with AI. The core idea here is that there are these massive external forces that are putting a real squeeze on every company's AI strategy. It's basically forcing them to either adapt or get left behind.
And what's so fascinating is how all these pressures are hitting at the same time. You've got regulators all over the world finally getting serious with actual concrete rules. Then you have ESG investors, the ones focused on environmental, social, and governance factors, and they're asking some really tough questions about responsible AI. And hey, you, me, all of us, we're savvier customers now, and we expect companies to use AI ethically. Put it all together, and if your competition builds more trust than you do, you're in trouble. It's a perfect storm, really.
So, keeping that perfect storm in mind, let's look at the classic shareholder first model. You know the one. It's all about maximizing profit. For decades, this has been the go-to for so many companies. But under all this new pressure, it's starting to show some pretty serious cracks. And here's the first big problem. Just doing the bare minimum to follow the law, that's not going to cut it anymore. The whole shareholder model tends to treat rules as a checklist to avoid getting sued. But what your customers, your employees, and your investors expect, that's moving way faster than the law is. And that gap between the legal floor and what people actually want, that's a really dangerous place for a company to be hanging out. This brings us to another huge vulnerability. That relentless drive to use AI to cut costs by replacing people. Yeah, it might look good on next quarter's earnings report, but the research is clear. It creates all these hidden costs. You lose decades of knowledge that just walks out the door, your team's morale just tanks, and suddenly you can't attract the best new talent. Over the long haul, those hidden costs can totally wipe out any short-term savings. Okay, so on the flip side, let's pivot to the customer-focused model. The whole argument here is that this approach, just by its nature, has some strengths baked right in that make it way more resilient to all those pressures we've been talking about. This chart really nails the difference, doesn't it? The shareholder model is always playing defense, just reacting when new rules come out and treating ethics like another business risk to be managed. And that often leads to high turnover. The customer model, though, it's on offense. It's proactive. It's trying to get ahead of the rules by building trust. It sees strong ethics as a way to win, and it treats its people like the assets they are. You've got one model that's brittle, just waiting to snap, and another that's built to bend. And here's the kicker. There's a real financial payoff to this customer-focused way of thinking. Because these organizations are aiming higher than what the law requires today, they're often already in a good spot when new laws show up tomorrow. That means less panic, fewer fire drills, and, get this, lower compliance costs in the long run. They're basically playing chess while everyone else is playing checkers. So, does this mean the shareholder model is just doomed? Well, not necessarily. The research shows there are ways for it to adapt and survive. And even the customer model, the resilient one, needs a game plan to stay on top. The research actually maps out this kind of evolution for a shareholder-focused company. You can start where you are, just focused on compliance. But to survive, you've got to move up. First, you become aware of risks beyond just legal fines, like your reputation. Next, you start really listening to your customers and employees. And the final step, the hardest one, is to actually weave ethics into your DNA. Not as a slogan, but as a real limit on just chasing profits. But here's the thing. You can't just get to the top and coast. To keep their advantage, customer-focused organizations have to keep pushing. That means building systems so they're always learning, gaming out future problems before they happen, and even working with competitors to figure out what best practices even mean. They have to treat good governance itself as something worth innovating. So what's the end game here? Where is all this heading? Well, our last section gets into a really fascinating idea that maybe, just maybe, these two very different models are starting to look more and more alike. The big idea is that those external forces we talked about at the beginning, the regulators, the investors, the customers, they're so strong that they're basically shoving both models toward a middle ground. The shareholder model is being forced to care more about people, and the customer model is getting proven right by the market. And this chart really drives that point home. Look at the pressure coming from every direction. It's high across the board. The walls are closing in. There's just less and less room for a purely profit-driven, do-the-minimum model to survive without getting hit hard from all sides. But, and this is a really important but, convergence doesn't mean they become exactly the same. There's this core philosophical difference that's probably always going to be there. It boils down to one question. Why are you being ethical? Is it because it's good for business and helps you make money? Or is it because it's, well, the right thing to do? That fundamental why will probably always separate these two approaches. So we'll leave you with this to think about. When you look at how AI is being managed in your world, ask yourself this simple question. Is our strategy built to adapt to a world that's constantly changing, or is it just built to comply with the world as it is right now? The answer to that question might just tell you everything you need to know about its chances of survival. Thanks for joining us for this explainer.